First segment, what is it?
Explain it like I'm 5.
I love explaining like I'm 5 because there's so many complicated financial things in this world, and everyone feels like they don't know, and everyone feels like they're the exception, and everyone feels like they're behind. And so I like to make things super simple. So what are we explaining today, Jen?
Okay, so at the time of this recording, the Federal Reserve just cut rates. The news cycle is ablaze, although when is it not ablaze? So what does it even mean for the Fed to cut rates? How can they dictate what interest banks charge for loans? Explain it like I'm 5. Or like we said, maybe like I'm 15.
Yeah, five is tough. We're learning our numbers at 5, but I'll do my best.
Okay.
I have to be a little bit vulnerable and admit something. When you hear all the time in the news, the Fed's cutting rates, Jerome Powell, I mean, maybe you don't, but I do because I kind of follow this stuff. And even me, who has been doing this for 7 years, like, reads this stuff every day, I didn't really know what that meant. Like, I kind of understood that these rates they're cutting were interest rates. They kind of relate loosely to mortgage rates and savings accounts rates. Mm-hmm. But like, what is the Fed? How can the Fed tell the Bank of America what your savings account rate should be? What like actually is going on? And so I like really tried to learn deeply just for this episode so I could understand and explain it to you like we're all 5, I guess. And here's my understanding of what's going on. Banks are in the business of accepting deposits and paying interest. So if you are a saver, you can go up to a bank, you can give them $100, and then every year they'll pay you 2% interest or whatever it is. And they're also in the business of loaning out money. So if you want to buy a home or grow your business or buy a car, you can go to the bank and then they'll give you money. And then the rate that they pay you for savings accounts, like these days, is around 3 to 4%. And the rate that they charge you for loans is around 7%. And so banks, that's their business model. They take all this money, they loan it all out, and then they pay less than they're charging. And then the delta is how they make money.
Right.
And so then where does the Fed come in? Isn't that like, and I think if there's only one bank in the world, like if we had this like little village with 100 people and there's one bank, it would be that simple. It would just be, everyone's money is in the bank and the banker's job is to keep track of it all and they make money in the delta. But we don't live in that simple of a society. We live in a society where, or at least in the US, in a country where there are thousands and thousands of banks and money constantly is flying between these banks as people make transfers and paychecks come from corporations to your account, and there are wires and there are deals and there are all the reasons that money is moving around. In order to track those transactions between individual banks would be logistically very, very difficult and problematic, because if one of those banks ended up not being able to make good on that transfer, the whole thing could like crumble and people and banks wouldn't trust each other and et cetera. Right. And it would be a very unfluid situation. So the Fed comes in, and the Fed is very, explain it like 5, is kind of like the bank's bank. The banks, like, so if I'm in San Diego, if I go to San Diego County Credit Union, not a pitch, but it's like the closest bank to my current location.
Okay.
They keep their money at the Fed, as do all the other banks. And so when, my credit union has to send Bank of America money, it's really a transfer from the balance at the Fed between San Diego County Credit Union to Bank of America. And so the Fed is all the bank's bank. And that means since the Fed is tracking all these transfers between banks and holding all that money and also potentially lending out money themselves, the Fed can kind of set their own rules and they can set their own rate. And so when the Fed says we're raising or lowering the rate, what they're saying is, hey, when banks move money between each other, we're setting the rate at which those lend, like, since we control the rules, we control this bank, we're setting the rate. So let's say, San Diego Bank wants to give out a mortgage and they need more money. They need to go borrow it from another bank. The rate that they get on that loan is set by the Fed, more or less.
Okay.
And so that's basically how the Fed can set rates that then affect things. And then there's this trickle down, since that's the rate in this Fed bank between the banks, then there's this trickle down that happens to your savings account. So right now, if you go to get a high yield savings account, you're going to be getting about 4% interest. And if you go to get a loan, you're going to be paying about 7% interest, all based on this trickle down from what the banks need to pay to get that money, or what they're getting paid to lend that money that's set by the Fed. Did that make any sense?
It actually did. And I'm glad. It makes me feel better that you had to do some research, because I was truly curious. And we hear about new Fed picks and interest rate cuts. And we're just, I'm confused. As the layman, I'm confused. So I'm glad that you had to do research as well, because you're supposed to know this stuff, okay?
It's complicated.
It's
and
complicated.
Everyone feels behind. That's why we're doing this show.
Yeah, I guess my only thing is me, Jen Mundia. Does this affect me directly? You know, if I'm listening, does this affect me? You kind of know a little bit about my life at this point. Would this affect me?
So that's a really good question, because there's the technical question of like, why does this work, or how does this work? And then there's, the tea leaves that everyone's reading when the Fed comes out with news. We're lowering the rates, we're raising the rates. What does that mean? And the answer is, it kind of depends on you. So if you're a person who doesn't borrow money and has tons of money in cash sitting in a high yield savings account, then, for the moment, you actually would prefer higher rates. You would much prefer 4 or 5 or 6% interest than zero. A few years back, rates were very, very low. And if you went to put money in a savings account, you would get about 0% interest, or maybe 0.1. Now it's more like 4%. If you're on the flip side, if you're not a saver, but you're a borrower, then you would prefer lower rates. So if you're going to buy a home right now, home buyers or potential home buyers are really looking forward to these rate cuts, because right now, 7% rates compared to recent history, when they were more like 3 or 4% for a mortgage, make your monthly mortgage payment a lot more expensive, like almost double in a lot of cases. Mm-hmm. And so when they hear the Fed's lowering rates, they say, hey, that means that maybe banks are going to start offering cheaper mortgages, so I can go buy that home that I couldn't have afforded before. And so as an individual, it kind of just depends. What are you doing right now with more of your money? Are you borrowing more money, or are you saving more money? Most people tend to prefer lower rates, because things like mortgages are more impactful to people's lives than savings accounts.
Yeah.
That said, economies are impacted differently. Economies like lower rates, like the whole U.S. economy, real estate, buying real estate, building real estate, borrowing money for, hiring employees, like all these huge companies doing things, they want to be able to borrow money more inexpensively. So for example, if I'm trying to buy a new gigantic $100 million apartment building or something, if I can get it at 4% or 5%, that could make or break the entire deal.
Right.
And so when the Fed basically has this big lever, lower rates, higher rates, lower rates, higher rates. And they're trying to navigate the economy with this one lever. And so all the companies are saying, hey, lower rates are good. But the problem is, if they just make lower rates all the way to zero, what happens is it basically floods new money into the economy. All these loans appear, new building, new hiring, yada, 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 yada. And that actually has this inflationary effect, where now, since all this new money floods into the economy, suddenly people have more money, and suddenly businesses can charge more money. And then you go to the grocery store that we've experienced the last few years, which is when a lot of money flowed into the economy, and now groceries are twice as much money. And if that inflation gets out of control, it can tear an economy apart at the seams. And so if inflation's getting high, the Fed yanks this lever back and says, well, we're going to raise rates to lower inflation. We're going to slow the influx of new loans, slow the influx of new money into the market, and to lower inflation. But then if businesses start laying off people and building stops, they're like, oh, that's not good. We're going to push the lever the other way. We're going to lower rates to increase business activity, so that we don't have business slowing. And right now, unfortunately, what Jerome Powell said is kind of both. He's saying job growth is slowing, which is a cause for lowering of rates, but inflation is still too high, which is a cause of raising of rates. And so he's basically stuck between a rock and a hard place, and everyone blames him. So
right.
That's my understanding of rates. How'd that go?
That's pretty good. I actually feel like I have more of an understanding, and I'm glad that you touched on how this affects inflation, because that's been a big conversation so far as well. So thank you. I'm learning on my own podcast.
Yes.
Shout out.
As am I. I learned, I think I have a better understanding of this, behind the scenes Fed Bank of Banks and why their rates matter.
No, you did a good job. You should be a teacher.
All right.
Sell courses.
Yeah. Oh my gosh, what a great idea. Our last episode, I wanted these to be more like in the 20-ish minutes, so like you can listen to on a commute, and I'm very long-winded, as you can tell, and we're already in a long episode. But so let's move on. What's our next segment?
Let's move on. But it's okay. I'd rather have the information, know the full extent of it, than cut things down. So